Welcome back to our in-depth modules on mastering LLCs for real estate investing. If you recall from the first module, we built a solid understanding of why the right business structure like an LLC can shield your personal assets from the everyday risks of property ownership such as tenant lawsuits or unexpected repairs. Now, we're advancing to the next module. Choosing the right state for your LLC. This module is crucial because the state you select is a strategic decision that influences everything from your tax bill and privacy to how easily you can secure financing for your next flip or rental acquisition. We'll go even deeper here, unpacking layers of pros, cons, real-world implications and lesser-known nuances, all tailored to REI. I'll draw on updated 2026 data from reliable sources, weave in expanded stories of investors who've navigated these choices, with names changed for privacy, and break down complex concepts into bite-sized, relatable pieces like comparing states to different neighborhoods in a city, each with its own vibe, costs, and hidden gems. Remember, while this is packed with factual insights, it's not personalized advice but consult a state-specific attorney or CPA, as laws can shift with new legislation. As of January 2026, with economic pressures like rising interest rates and inflation, more investors are scrutinizing state choices to optimize costs and protections. Let's explore this thoroughly, starting with the foundational debate and drilling down into each element. Kicking off with the pivotal choice, home state versus out-of-state formation. This isn't a one-size-fits-all decision, it's about aligning with your REI strategy, whether you're a local landlord managing a few single-family homes or a cross-country wholesaler chasing deals nationwide. Forming in your home state, where you reside or where most of your properties are located, emphasizes simplicity and cost efficiency. You file once, comply with familiar local rules and avoid the domino effect of multi-state bureaucracy. For instance, if you're in Texas flipping houses in Houston, a home state LLC means a straightforward $300 filing fee, no foreign registrations, and seamless integration with local title companies and lenders who know the terrain. Pros abound. Lower overall costs since you're not duplicating fees or hiring extra registered agents, easier compliance with annual reports tied to one jurisdiction, and better lender perception, as banks often view home state entities as more stable for real estate loans, potentially unlocking better rates on mortgages or HELOCs. In real estate, where physical inspections and local zoning matter, this setup lets you focus on deals rather than paperwork. Take Angela, a part-time investor in Ohio who started with a duplex in Cleveland in 2024. She formed her LLC locally for $99, integrated it with her property management software, and when she expanded to a triplex nearby, everything flowed without extra hurdles. Her home state choice saved her $400 annually in avoided foreign fees, and when refinancing, her bank praised the clean setup, approving a lower interest loan that boosted her cash flow by 15%. However, cons include potentially higher state-specific taxes or less privacy if your state mandates public disclosure of owners. Think California with its $800 minimum franchise tax, which can sting for small portfolios. Out-of-state formation, like setting up in Delaware while operating in Florida, appeals for perceived perks like enhanced privacy or asset protection, but it often introduces complexity. You'll almost always need to foreign qualify back home, doubling filings and costs, so expect $100 to $750 per state for registration plus ongoing annual fees. Pros: access to business-friendly laws such as Wyoming's anonymity, which can shield your name from public records in high litigation REI environments, potential for lower formation fees in some states, and flexibility for multi-state portfolios, acting as a central hub. Cons dominate for many. Added administrative burden, like maintaining agents in multiple places costing $100–300 yearly each, and risk of non-compliance penalties up to $1,000 or more, and no real tax deference because rental income is taxed where the property sits, not where the LLC forms. Story expansion. Consider Derek, a California-based flipper who went out of state to Nevada in 2025 for tax savings. He paid Nevada's $425 initial fee, but then $800 for California foreign qualification, plus dual annual reports. When a San Diego property dispute arose, California courts ignored Nevada's protections, applying local laws and piercing his veil due to commingling, ultimately costing him $20,000 in legal fees he could have avoided with a home state setup. In 2026 trends, about 70% of small REI operators stick to home states for these reasons, per industry analyses, unless they're in high-tax areas like New York or scaling nationally. Ultimately, If your properties are concentrated locally, home state wins for efficiency. For dispersed holdings, weigh out of state only if perks outweigh the 20 to 50% higher ongoing costs. Now, let's demystify the hype around Wyoming, Nevada, Delaware LLCs are often touted as magical solutions for REI, but the truth is more balanced, especially in 2026 with evolving privacy laws and economic shifts. These states attract investors with low taxes and protections, but they're not always the best fit for real estate, where location-specific rules dominate. Starting with Wyoming. It's a frontrunner for affordability and privacy, with a $100 formation fee and $60 annual minimum, no state income tax, and strong asset protection via charging orders that limit creditors to distributions only, not seizing assets. For REI, this shines in holding companies and single-member LLCs get full protection, ideal for isolating rentals. Pros: top-tier anonymity with no public owner listings, low costs making it scalable for multiple properties, and no info sharing with the IRS beyond basics, reducing audit risks. In real estate, it helps shield from personal creditors, like if a car accident lawsuit targets you, then your Wyoming LLC-held properties stay safe. Story: Elena, a Colorado investor, formed a Wyoming LLC in 2025 for her mountain cabins. The privacy kept her name off public searches, deterring frivolous suits, and low fees let her allocate more to renovations, netting 25% higher ROI on flips. Cons: if properties aren't in Wyoming, foreign qualification adds fees like $150 in Colorado, and non-recognition in some states weakens protections. Plus, banks may require personal guarantees for out-of-state entities, complicating REI financing. Nevada offers no state income or corporate taxes, robust privacy, only managers listed publicly, and strong charging orders, with formation at $425 and annual $350. Pros for REI: excellent for multi-asset holdings, as it limits liability crossovers, and 2026 updates eased compliance for real estate entities. Cons: higher fees than Wyoming, and recent laws increased scrutiny on out-of-state users, potentially triggering audits. Not ideal if you're in a low-tax home state already. Example: Marcus from Arizona used Nevada for his Phoenix rentals in 2024, enjoying tax perks, but 2026 compliance changes cost him $500 extra in agent fees, and a lender balked at the setup, delaying a deal. Delaware stands out for its court system, and chancery courts handle business disputes swiftly, and privacy for LLCs because no owner names required, with $90 formation and $300 annual franchise tax. Pros: investor-friendly precedents protect in complex REI partnerships, and flexibility for raising capital via Series LLCs. Cons: franchise tax escalates with assets, hitting REI hard for large portfolios, less tax savings than Wyoming, Nevada, and out-of-state use means foreign quals everywhere. Story: Sophia in New Jersey formed in Delaware for her East Coast multifamilies in 2025. The legal muscle helped resolve a partner dispute quickly, but annual taxes ate $1,200, more than expected. In summary, these states excel for privacy-focused, multi-state REI, but for local ops, home states often outperform, and 2026 data shows only 30% of investors benefit from them without added costs. Foreign registration is the often overlooked bridge for out-of-state LLCs, and getting it wrong can halt your REI momentum. If your LLC transacts business in another state, like owning or managing rental properties, you must register as a foreign entity there. Transacting business in REI includes collecting rent, signing leases, or holding title, and an ownership of non-income property might not trigger it, but rentals almost always do. Process: submit a certificate of authority or foreign registration statement to the Secretary of State. Provide your home state docs. Appoint a local registered agent for service of process, and pay fees ranging from $50 in Hawaii to $750 in California, averaging $186 nationwide in 2026. Timelines vary because some states approve in days, others weeks. Include a good standing certificate from home. Pros: legalizes operations, allowing you to sue or defend in courts and secure local financing, essential for REI compliance. Cons: annual renewals fees range from $50 to $500, potential publication requirements like in New York, and penalties for skipping like fines up to $10,000, back fees with interest, or inability to enforce contracts. State specifics. In Texas, it's $750 with a certificate of existence. Georgia charges $235 via credit card. Story depth. Jamal from Illinois used a Delaware LLC for Michigan flips in 2025. Forgetting foreign reg, a contractor lien lawsuit was dismissed, costing $15,000 in delays, and he retro-registered for $300 but learned the hard way. For REI pros, plan ahead. Use services like Harbor Compliance for multi-state tracking, as 2026 saw increased enforcement amid business booms. Tax and compliance implications are where out-of-state choices can backfire, impacting your REI profitability. Taxes don't vanish by forming elsewhere because real estate income is source-based, so a Wyoming LLC holding Florida rentals pays Florida property taxes and federal pass-through plus any home state nexus taxes. Pros. Low-tax states like Wyoming avoid state income tax on non-local profits, potentially saving 5 to 10% for diversified portfolios. Cons. Dual franchise taxes like Delaware's $300 plus and California's $800, increased audit risks from multi-state filings, and for foreign investors, FIRPTA, 15% withholding on sales. Compliance. Annual reports in all states like deadlines vary and fees range from $50 to $800. Record updates and good standing maintenance and lapses dissolve LLCs, exposing assets. In REI, this means separate books per state, tracking depreciation, and non-resident returns. Expanded story. Lena in Chicago used Nevada for Texas holdings. Minimal tax savings, but missed renewals triggered a $200 fine and lender scrutiny during a 2026 refi, nearly derailing a $500K deal. Model with software. Savings often illusory for sub-1 Metas portfolios. Finally, red flags causing later issues, and these stealthy errors can unravel your REI setup. Top ones. Delaying formation like signing personally, expose assets. Wrong state choice like out of state without quals. Self as agent miss notices if unavailable. PO box address flags as non-legit to banks. Improper deed transfers. Means veil is pierced. One LLC for all properties is a cross-liability. Insurance gaps. Commingling funds. No operating agreement. Ignoring state rules. Overpaying services, outdated docs, no succession plan, insufficient records.